Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Sal Gilbertie. He is the president of Teucrium Trading, making a return visit. Sal, great to see you.
Always good to see you, Mike.
So what's going on? Tell us.
Well, we've been very active. Teucrium has 7 funds listed now. Our corn, soybean, and wheat funds allow investors to trade those products or invest in those products without the use of a futures account. They've all had options listed on them now, so these are exciting times for Teucrium.
Sure.
And there's big news in the corn markets.
Such as?
Well, farmers have responded to the high prices, or at least they've attempted once again to do that, and we've got rain. So rain makes grain. It looks like we'll have a record or a near record crop with the seeds that are planted in the ground now. The crops are growing. We're 95+% planted, which is a very good thing. And it looks like we'll replenish what has been a very tight corn balance sheet and an even tighter soybean balance sheet.
So where are we in terms of the price outlook? If we're looking potentially at a record or a near record crop, I mean corn, I think, in the 5 handle, is it going to stay there, or shouldn't we come down a little bit more?
That's hard to say. History would tell us that at the projected inventory levels that we anticipate having this coming autumn, we've traditionally had lower prices than you see in the forward curve now. That is the case. So I think it remains to be seen what will happen, because what you have is this increasing population, 75 million people a year on Earth approximately, new, added to the global population. All of us, each and every human on Earth, uses a lot of corn, a lot of grains, directly and indirectly. And so while the price and supply may become more adequate and the price may actually decline, the trade calls it buying demand. The lower price, people tend to use more grains. And if you look back over history, say the last 5 years, you use about 12 billion bushels of corn, give or take a billion a year, and that largely is a function of price, I believe. And so if we do replenish the corn balance sheet and do produce close to 14 billion bushels this year. Last year we used just over 11 billion bushels. The guess is that this year we may use 12 or even 13 billion. So what happens is lower prices buy higher demand. That's kind of how it works, the cyclical nature of commodities. Yeah, and
you also point out something, that's I think very appropriate, or we should talk about, is the fact that the markets respond to changes in price by adjusting the amount of supply, and historically, that's how come we see these sort of cyclical moves in commodities, because we do keep up with the amount of demand. You talk about record corn crop now, so it is responding to that, and we're seeing more supply come to the market. Tell me a little bit about, because you're really on the front lines in terms of investors. You see investor behavior through, the activity in your fund. The pullback in commodity prices, how has that affected people's attitudes towards commodities as an investment?
Well, that's a great question. And you generally have 2 classes of people that we can see, and those are investors and speculators. So you've got short-term traders, speculators we'll call them, and in a time of surplus, declining prices, you often see many of those people pulling away from the market. However, their offset, often they are more than offset. Their exit is offset more by long-term investors who are mainly asset allocators, people looking for portfolio diversification. They tend to buy. Ags are very interesting, because many people have famously said, do not bet against the American farmer. Don't bet against any farmer. These guys respond to prices, they respond quickly, and there have been many studies showing that the supply of ags can increase very rapidly when you have a proper price motivation point. And we've obviously had that because of the drought.
Right.
Farmers are trying their best. Again, there's rain this year, so it's likely that globally it seems we're going to have a very big supply of wheat, ex the U.S., which is having some issues. But soybeans, we should see an increase in balance sheet due to South American production and U.S. production increases. Corn, everybody's growing corn. Anybody who can grow corn. China, South America, the U.S., elsewhere, big corn crop is expected. That's a response. And how that's met is with generally a decline in price. May or may not happen because the forward curve is already quite steeply, it's backwardated. So meaning the front of the corn is worth a lot more today, which is old crop corn, than new crop corn is worth because people anticipate this higher price.
Now, how do your funds behave? And I think your funds are unique in this sense in terms of the curve, the price curve, whereas some of the other funds, investors have to be careful about contango, and that's a cost to the fund on a monthly basis when you have to roll that over. Is there something built into yours that adjusts for that?
There is. We actually hold the forward curve. We never hold spot month. We always hold, it's a formula base that can be found on our website. It's a fixed formula, so people know what it is always. And that allows us to have somewhat less volatility. These are still used as trading vehicles. But for investors, these long-term buy and hold investors who are cycling their money in at these times of coming surplus in order to diversify their portfolio, they need to worry a bit less. You always need to worry about it. Even our funds can't eliminate contango or backwardation.
How far out do you hold? You said you hold it
in our grain funds, we hold about, often a little more than a year out. We always hold the far December or November in corn, wheat, or beans.
Right.
And so, right now, we're going more than a year out on the curve, which is good for people who have a one-year time horizon. Asset allocators who know that corn, sugar, soybeans, wheat, they all have very low correlations to the S&P 500. Those are things that will reduce the volatility. They've been proven empirically to reduce the volatility of your portfolio over time. Those are people who are going to invest on these down cycles, for sure.
So would you say to people, if they're going to use an ETF, it's better to have a longer term time horizon than if you just simply want to be a trader? I mean, you obviously would like to see the action in your fund, but I mean, what would you say to people in terms of their time horizon?
I'd say you can match your ETF to your time horizon. So your exchange-traded product that you're using, if you have something that holds front month or concentrates its positions
use that as a trading vehicle.
Absolutely, use that as a trading vehicle. If you have something designed more like the Teucrium funds that mitigate contango and backwardation, those are what you're probably inclined to use more for a long-term holding in your portfolio. Interestingly enough, in those few funds, and Teucrium has several of them, are corn, soybeans, and wheat funds, there are no other exchange-traded funds. So you have to trade ours. Ours are used for both investing and trading. But you have a wide variety of choices across the spectrum, especially in energy, of good products that can be used for trading, and then other separate products that can give you exposure, say in oil, that can be used for investing. In fact, our oil fund holds further out the curve than anyone else. Very often we're 2 years out based on the formula. Again, it's a formulaic.
Now, you talk to a lot of people in the trade, producers, people who actually use or produce physical commodities. How do they feel about, this explosion in index funds generally?
I think generally...
Do they think it's a good thing, a bad thing? I mean, how do they...
You know what? If you're an efficient forward hedger, my inclination is you think it's a good thing. If you believe that there's plenty of liquidity out the forward curve coming from the buy side, you're a natural seller as a producer. You're going to see those prices. You're going to be able to judge adequately when you can increase your production of whatever.
But most of that, and you kind of mentioned that, most of that's going into the front month, into the spot month. I mean, you're unique in the sense that you invest farther out the curve, but isn't a lot of that speculative money just coming into the spot?
Some is. Almost none actually is coming into the spot because there are very severe position limit restrictions. If you're not a trade participant that can make or take delivery, you're really not going to trade spot month. So most of your big passive index funds, which I think is what we're talking about here, they're holding second month, third month, or some month generally in the front of the curve, whereas other funds are designed to hold, across towards the back of the curve. So I think unless you're talking about the deliverable month, of which I don't know of any funds, and this excludes the precious metals, because the metals funds actually hold the physical. That's a different thing entirely. They're affecting supply-demand. I believe that's true. But in terms of paper markets, until someone actually makes or takes delivery, it's not going to affect the true price to the consumer, because the consumer's buying the hard asset in the end.
You mentioned regulatory aspects. How do you think the regulatory environment may affect, if at all, what's happening, for example, with your fund or investment vehicles of this nature?
Well, it's twofold. I think that position limits that could become more restrictive, and we don't anticipate that will happen, but position limits that become more restrictive could limit the size of these funds, and if you're limited on size, you really can't track your benchmark as well as you'd like to. So that's going to harm investors because they want a predictable benchmark tracking vehicle in which to invest. But I think that more to the point, the regulation of there's a lot more paperwork to fill out right now. Dodd-Frank is an enormous document, and that's the law. But what most people don't understand is that there are regulations that actually enforce the laws and allow the laws to be implemented.
They're supposed to anyway.
They're supposed to, that's right. But I've heard various numbers, but about half of Dodd-Frank has regulations written to go with the law, and those regulations are quite substantial. It's a very heavy burden. Most trading companies with whom we have contact, they are shifting personnel from what we would call the more productive, trading, planning, building infrastructure things. They are shifting or building personnel more for compliance and regulatory, and that's not a bad thing. Understand that there's a reason why the U.S. has the safest markets in the world. All of this regulation is good, not bad. And so long as it doesn't take enough energy away from productive enterprise to maybe affect forward production levels, because we need more production because there's more people.
Right.
There are
so
more people.
Bottom line, would you say less volatility in the future?
That's hard to say. If anything, I think regulation might even promote more volatility.
Really?
Because there's some artificial barriers there. You don't want artificial barriers because if you limit supply, you create more volatility.
All right. Be careful what you wish for. Sal Gilbertie, thank you very much for being on the show. I appreciate it.
Pleasure.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.